Okay, video number 6. Second to last. This was going to be the last one, but I think I'm going to need one more before we're done. What we're going to look at now is how to deal with any tax you have to pay on your shares. So capital gains tax and potentially tax on your dividends as well. Now this is not contained within your task sheet instructions, but sometimes if you want to go for the A, you have to kind of go above and beyond just what the sheet tells you to do. So we're going to have a look at how you might look at capital gains tax and tax on dividends for my example. So we'll start with capital gains tax. Remember, we have two scenarios here. We have the hold scenario, where you keep them for the whole 5 weeks, and then we have the trade scenario, where you sell at least once. So in my case, in the last of my 5 weeks, I sold my shares in Rio Tinto, and I used those proceeds to buy shares in Qantas instead. And then I sold those shares in Qantas and all the other remaining ones at the end of the 5 weeks. So that was what we called the trade scenario. So we'll start with the hold scenario here. So just a reminder, a capital gain is when you sell shares for more than you bought them for, and that includes brokerage and GST. So the capital gain is going to be the total cost of buying the shares, take away the net proceeds. That's the amount of money you get from selling after brokerage and GST has come off. If that number ends up being a negative, that means you've made a capital loss. So for me, it's my 4 companies here. I have to do this calculation individually for each of them. You'll see that for all of them except for the National Australia Bank, I made a capital loss after I'd taken brokerage and GST out. And that's because the price didn't really change much over 5 weeks. NAB was the exception, National Australia Bank. I made a capital gain of $16.10 on that. So overall I have $351.56 in capital losses and $16.10 in capital gains. So remember, I can use those capital losses to offset the capital gain. So that's what I've done here. I've used $16.10 of my $351 to completely wipe out that capital gain on the NAB shares, and I'm still, after I've done that, got $335 of capital loss left. And those capital losses can be used later on. So if I was to do some more share selling later on, and I actually made a fairly large capital gain, let's say $500 or more, when it comes to tax time, I could use that $335 to offset that capital gain. So in my case, it's pretty simple. I don't actually have to worry about capital gains tax in this scenario. But if I did, then it would be a case of doing the whole of the capital gains. Remember that after 12 months, you're allowed to just be taxed on half of your capital gain. But in this case, we've had these shares for way less than 12 months. We only had them for 5 weeks. So when we sell them, if we make a capital gain, we have to pay tax on that whole capital gain. And the tax rate, remember, is the marginal tax rate. So if you do come up against that situation in your DI, make up a scenario. Say my guy, Jim Bob, whatever his name is, he has a marginal tax rate of however many percent. Okay, so that's the hold scenario. Next one, trade scenario. So in this case, Telstra, JB Hi-Fi and National Australia Bank will have the same capital gains or losses that they did in the hold scenario, because remember, I kept those all the way through. It was only Rio Tinto that I sold. So I have to redo the Rio Tinto calculation, and I have to use the price that I got for them when I sold on the 23rd of August in my scenario, in my DI. So by selling on the 23rd of August, I made a capital gain of $11.45. I then bought shares in Telstra, and at the end of the 5 weeks that the DI went for, I sold those shares in Telstra, sold those shares in Qantas, and made a capital gain of $27.56. So this time, when I add all the numbers together, I have $200.40 in capital losses and $55.11 in capital gains. So again, my losses are larger than my gains, so I can use some of that capital loss to completely wipe out my capital gains. I'll have $145 left off afterwards. So again, I don't have to pay capital gains tax. And I think you'll find, as I said earlier, that for most people, because the market's been pretty static in the 5 weeks we've looked at, most of you guys are not going to make very large capital gains or no capital gains at all. You'll probably make a capital loss overall. So you're probably not going to have to worry about paying capital gains tax. Okay, so that's the capital gains tax part of it. Hopefully this helps. If your scenario is way different and you do have to do capital gains tax calculations, maybe try and get hold of me. I'll go through how to do that, or look in your textbook. Next one. Oops, nothing there. Tax on dividends. Now in this case, you need to work out whether your dividends are franked or not. So the only one that I had dividends paid in my scenario was Telstra. And my dividends were paid on the 19th of August. Now, nowhere there does it tell me whether those dividends were franked or not, so I need to actually find that information, and as far as I can tell, it's harder than it looks. For me, I couldn't find the actual information on those specific dividends anywhere on the Google or Yahoo websites, so I had to go to the actual Google engine itself and search for the following: Telstra dividend advice, 19th of August 2013, so the date it occurred on. What I found was this here. It's a PDF of an announcement from Telstra to shareholders. So when I open that up and I have a scan of it, where are we? There's a lot of stuff here, so you might have to read it carefully. There we go. So it says here that those dividends are actually franked, so they've had the 30% tax removed from them. From there, if you wanted to then take this further, you could calculate the imputation credits in the same way that it was done in the textbook, and you could then, for your scenario, for your imaginary person that this DI is about, invent a marginal tax rate. So say my person, Jim Bob, he has 17% marginal tax rate, he has 42, he has 30, whatever, and then work out whether they're going to be entitled to a tax credit or a tax bill for that. So that would be done in the same way that's covered in the textbook. I'm not going to have a look at that just now. Again, this is not something that you have to do, but if you want to shoot for the high grades, it might be worth having a go at this. I just thought it was important I showed you, as far as I can tell, how you go about actually finding that dividend information. And it's not easy, you're just going to have to hunt around. Okay, that's me done for this time. The final one is going to focus on how to actually find the information you need to write your report.